All right, welcome to the final session on your business valuation and analysis class for semester 5, which is on mergers and acquisitions and also takeovers and how these instances are going to be accompanied with business valuation. So, this is a section you will be getting a question in your final exam, but I don't think I will be asking you to do any calculations per se. Rather than that, your understanding of these concepts and the impact on business valuation is what I really want to see. So, in that front, I think you don't have to worry about coming any calculations on this topic to your final exams. But even beyond the exams, these things are happening in real life every day in certain cases. So, I would really want you to think more on how these mergers and acquisitions would happen in real life and common scenarios associated with it, and the valuation of business entities. And having that sort of understanding could be quite helpful in your future careers. That's what I really want you to focus on. So, without further ado, let's start with our session. So, acquisition, mergers, takeovers. Let's dive into each one of these. So, what is an acquisition? Acquisition involves one company purchasing another. So, as simple as it could be. But this can take various forms. First one is purchase of assets. So, this form an acquisition occurs when one company buys specific assets from another company. For example, when Google purchased Motorola's mobile phone business in 2011, it primarily acquired Motorola's patents and hardware assets, which was valuable for bolstering Google's Android ecosystem, right? So that's one way of acquiring another firm, with specifically focusing on the acquiring firm's assets. And then the second part is purchasing of a segment, or rather, the second aspect of acquisition is purchasing of a segment. So, in this type of an acquisition, a company would buy a definable segment or division of another entity and let's consider an example for this. So I think in 2014 or 15, Lenovo acquired IBM's x86 server business. So Lenovo did not purchase in IBM in this case as a whole, but focused on specific segment, which was the x86 servers. So this allowed IBM to concentrate on its software and services divisions, while Lenovo expanded its hardware capabilities. And the third part is, so in the first one, it is purchasing of assets. Second one is purchasing a definable segment. Third one is the purchasing of the entire company, which is also noted as a merger. So this involves acquiring the whole company, and one of the most famous examples is Facebook's acquisition of Instagram in 2012. So Facebook purchased Instagram for entirely for about $1 billion in cash and stock, aiming to enhance its mobile photo sharing capabilities and reduce competition in the social media space. So that's how an acquisition is, and different forms of acquisitions take place. And then we come into another form of, it is sort of an acquisition, which is called an integration. But rather than an acquisition, this is considering of an connection or combining of two or multiple firms. So under integration, we have several types of integration. The first one is a statutory merger. So in a statutory merger, one company legally absorbs the another, with the latter ceasing to exist. So a prime example for this is Disney's acquisition of 21st Century Fox Studio in 2019 for about 70 or 80 billion dollars. I'm not quite sure. So, post acquisition, 21st Century Fox's entertainment assets became part of Disney, and the company ceased to exist independently. And then after the statutory merger, we have the subsidiary merger. So in a subsidiary merger, what happens is the acquired company becomes the subsidiary of the purchasing company. So again, another famous example here is Google's acquisition of YouTube in 2006. So Google purchased YouTube for 1.65 billion in stock, and YouTube continued to operate as a subsidiary under Google's ownership, which is again now called as Alphabet Incorporation. And finally, we have consolidation. So consolidation occurs when two companies merge to form to a completely new entity. So DuPont and Dow Chemicals merged in 2017 to form Dow DuPont. So this was a, I think, that merger was over $100 billion. So it created a new entity, so which was later split into three separate companies focusing on agriculture, material science, and some other specialty agriculture and fisheries related products. So these three different forms of integration, you can see how real examples have taken place under each of these cases, and we are going to focus on the valuation aspect of it soon enough. Then we are going to discuss about the different types of mergers. So we have horizontal, then we have vertical, and then we have conglomerate merger. So horizontal merger, let's first discuss about it. Horizontal merger occurs when companies in the same industry to increase market share and achieving economies of scale. So some oil giants, I'm sure you have heard of it before, Exxon and Mobil in 1999, they performed the horizontal merger and created ExxonMobil is a quite classic example. So I think that was also closer to $100 billion at that time, and it created the largest oil company in the 20th century, allowing for significant cost savings and a strong market position. And then we come into the vertical merger. So, vertical merger happens between companies at different stages of the supply chain. For example, in 2002, eBay acquired PayPal for, I think again that was for $1 billion, and this was a backward integration which allowed eBay to streamline its payment processing, enhancing the user experience on its platform and reducing a transaction cost. So at that point, eBay was in the higher stages of the supply chain compared with the PayPal, which is simply a payment management software. By the time eBay was functioning in 2002, it was one of the largest e-market platforms in the world. So that backward vertical merger made sense because it enabled eBay to really focus on their payment platform, which was missing in its initial days. And then we come into the conglomerate merger. So in a conglomerate merger, companies in unrelated businesses merges for diversification. One of the famous instances is Warren Buffett's Berkshire Hathaway has executed numerous conglomerate mergers. So they acquired Precision Castparts Corporation in 2016, and this was a quite a good example of diversification because it significantly diversified Berkshire Hathaway's portfolio by adding a manufacturer of complex metal components for aerospace and industrial markets, which was in a booming stage at the time, so that made sense. And then synergies in mergers. So synergies is again a buzzword which is often used in mergers and acquisitions. So we need to understand what exactly a synergy is. So synergies refer to the potential financial benefits achieved through combining companies. So these could include cost synergies such as the reduction in cost due to economies of scale, shared resources between the companies, and increased operational efficiency, and revenue synergies like increased revenue through expanded market reach, cross-selling opportunities, and complementary product offerings. So basically, the competitive advantage both the target and acquirer is going to gain as the result of an acquiring or a merger is basically identified as the synergy, right? So in there, I spoke about two keywords, right? Target and acquirer. So what is the target? What is the acquirer? Target is the company which is being purchased. So while the target is the company being purchased, acquirer is the company making the purchase. So understand the dynamics between the target and acquirer is crucial for assessing the strategic fit and valuation impact of the transaction. And then we come into the most beautiful part of this session, the different type of transaction: takeover or hostile transaction versus friendly transaction. So a friendly transaction occurs when the acquisition is agreed upon by both companies management and boards. For example, when Amazon acquired Whole Foods in 2016 for $15 billion, I think it was 15 billion, it was a friendly transaction with both companies leadership fully cooperating to ensure a smooth transition. But on the contrary, a hostile transaction, again, which is identified as a takeover, occurs when the acquiring company attempts to purchase the target company against its wishes, often by going directly to shareholders or fighting to replace the management. Now, you might wonder how these type of things could happen in the corporate world, where it is not possible to imagine that your own company, whether it is publicly traded or not, is going to be uh, forcefully taken away from you. So this is a very complex scenario because uh, now I'm going to derail from the session for a bit. So a lot of these corporate heads or corporate senior personnel, they many of them have giant egos and they really expect a ego boost when they perform incidents like this. And I'm not sure whether you have watched this series called Suits. It's one of my favorite series of all time, and it is a legal drama. Which happens in, I think it happens in New York. So uh, there's this a legal firm, and a lot of litigation aspects are involved when a hostile transaction is going to be taken place. And if I remember correctly, an entire season was dedicated to a storyline on a hostile takeover on one of their clients. So even television shows understand the dynamics when it comes to hostile transactions are quite significant, and they adopt it into media. So when these things happen in real life, it's somewhat overwhelming to think about because the scope or the dimension of these transactions are quite significant. It's often dealt with billions of dollars. So it's quite interesting to look at these things. And in our perspective as analysts, as valuers, we need to understand the exact value which is going to come right before the hostile or friendly transaction takes place, and once uh, it is done, then also we need to make sure the proper value of the company is evaluated. So just wanted to give you a brief idea on that too. And as I was saying, in the hostile transaction, the forceful acquire process is going to be taken place. So a notable example is Kraft Foods' hostile takeover of Cadbury in 2010. This was initially resisted by Cadbury when Kraft made their initial offer, but Kraft ultimately succeeded in acquiring the Cadbury company, which is British confectionery company, for I think $20 billion. So it significantly expanded its presence in the confectionery market. But you can see initially it was rejected uh, by the acquired company, which is Cadbury. So in an overall idea, acquisitions, takeovers, and mergers are strategic moves that companies use to grow, and they also use them to diversify or enhance their competitive position. So, understanding the forms of integration, types of mergers, and the differences between friendly and hostile transactions is crucial for evaluating the potential benefits and challenges associated with these corporate strategies. Right, so I think that would be a good starting example and a good introduction to our session. And let's move forward with the motives for merger. So, motives for merger. Mergers are driven by various strategic, financial, and operational motives. So, you can see a lot of different motives are provided here. Let's go through them one by one. First, we have synergy. So, we already discussed about this. Synergy refers to the potential financial benefit achieved through the combining of the companies, right? The competitive advantage the company is going to gain as a result of the merger. So when two firms merge, they can create more value together than separately due to cost savings, increased revenue, and efficiency of their operations because of this merger. So, example, when Disney acquired Pixar in 2006, again it was $1 billion acquisition. This synergy was evident in combining Disney's marketing prowess and distribution network with Pixar's innovative animation technology and creative talent. So this merger resulted in a string of successful films, enhancing revenue and profitability for Disney. For example, if you think about Pixar's most successful movies, they came after 2006 or 7, right? Movies like Up came in 2009 and Tangled came in 2010. So you can see Disney's a giant in entertainment business, and Pixar was a creative monster. So when you have a merger like this, quality products are expected to come right after. And then we have growth, obviously, right? So mergers can provide immediate growth opportunities that might take years to achieve organically. So this can include expanding into new markets, increasing market share, or acquiring new customers. So you all know about Facebook's acquisition of WhatsApp for 20 billion in 2014, right? So this was driven by growth motives. WhatsApp at then had a massive user base, especially in emerging markets, which allowed Facebook to significantly expand its reach and enhance its global presence. And then you have increasing market power. So mergers can also increase companies' market power by reducing competition and increasing pricing power or enhancing bargaining power with suppliers and customers. So When the merger of Anheuser-Busch and InBev happened in 2008, this created world's largest brewer. So AB InBev, this merger, after the merger, the company was named as AB InBev. So this merger significantly increased their market power, allowing them to dominate the beer market and negotiate better terms with suppliers and distributors. And I'm sorry. Then we have acquiring, yeah, unique capabilities and resources. Companies again may merge to acquire unique capabilities, technologies, patents, or resources that they are lacking of, right? So this can also accelerate innovation and provide a competitive edge. For example, when Google acquired DeepMind in 2014, it was driven by the desire to acquire advanced artificial intelligence capabilities. So Google was lacking on that front, and DeepMind's expertise in AI significantly bolstered Google's capabilities in ML, and AI research. And then we have a diversification, another great motive for merger. So mergers can diversify companies' product lines, services, or geographical presence, reducing risk by spreading exposure across different markets and industries. For example, General Electric has historically pursued a diversification strategy through mergers and acquisitions. For example, when GE or General Electric acquired Alstom's their power and grid business in, I think it was 2016, this diversified General Electric's energy portfolio and enhanced its presence in the power generation and transmission sectors. And now we have an interesting motive for merger, which is bootstrapping earnings. So, bootstrapping earnings involves using the financial resource of the acquired company to boost the acquiring company's earnings per share, right? So, let's define it again. This is where the financial resources of the acquired company are used to boost the acquiring company's EPS or earnings per share, right? So when you do that, when essentially the earnings per share of a company is increased, that would be a great indicator for the investors to potentially come into this venture and invest their money. So, for example, a merger between two companies where one has high cash reserves and the other has high earnings potential can lead to bootstrapping. When Kraft acquired Heinz, right, the ketchup company Heinz, in 2015, the combination leveraged Heinz's strong cash flows and Kraft's extensive distribution network, boosting overall earnings in this merger. And then the personal incentives of the managers. So sometimes mergers are driven by managers' personal incentives, such as enhancing their own power, their own prestige, or their compensation. So while not this would not often be the best of the shareholders, these incentives can also play a significant role in merger decisions. So, for example, a CEO might push a merger that significantly increase the size of the company, uh, consequently enhancing their status and potentially leading to higher compensation, even if the merger does not create substantial shareholder value, right? So, no, no wonder, and that is not a surprise, managers are going to think about themselves most of the time, not about the shareholders. And then comes tax considerations. So tax benefits again could be a great motivator. Companies might merge to utilize tax losses, benefit from lower tax rates, or take advantage of other tax-related synergies. Uh, I believe in 2016 or 17, Johnson Controls merged with Tyco International in a massive 15 or $20 billion deal. And one of the key drivers was tax inversion, as Tyco was based in Ireland with a low corporate tax rate, allowing Johnson Controls to reduce its tax liability. And then you have unlocking hidden value. Sometimes mergers are pursued to unlock hidden values in the target company. So this might involve restructuring, divesting non-core assets, or optimizing operations to realize the company's full potential. So there's a very famous example for this. Activist investors often push for mergers to unlock hidden value. So in 2018, Elliott Management published for the merger of Athens Health with the Veritas Capital and Evergreen Coast Capital for, I think, $6 billion, arguing that the combined entity could unlock significant value through operational improvements and strategic initiatives. And then we have cross-border motivations. So cross-border mergers allow companies to enter new geographical markets, as the name itself suggests, and also to access new customer bases and leverage global supply chains. So when Fiat and Chrysler merged in 2014 and they created Fiat Chrysler Automobiles, This was a global automaker with significant presence in both Europe and North America, two of the largest markets for automobiles. And this cross-border merger provided access to new markets, diversified revenue streams, and enhanced global competitiveness. So you can see mergers are often driven by myriad of motives, each contributing to the strategic rationale behind combining companies. So understanding these motives helps stakeholders to evaluate the potential benefits and risks associated with mergers and ensure that they align with the overall strategic goals of the company. So by examining real life examples, which we went for all of these instances, we can see how these theoretical concepts are applied in practice, offering valuable insights into the complex world of corporate mergers and acquisitions. So as I was going over the motives of merger, I highlighted about the bootstrap earnings. So I actually thought about discussing it a bit more. So we know that bootstrapping is a way of packaging the combined earnings from two companies after a merger so that the merger generates an increase in the earnings per share of the acquirer even when no real economic gains have been achieved. So the mechanism we need to understand is the bootstrap effect. So this bootstrap effect occurs when the high price to earning ratio firm or high PE ratio firm, so it would generally be a high growth prospect firm, acquires a low PE ratio firm. That would means conversely it would be a firm with low growth prospects in a stock transaction. So this is achieved by exchanging the acquirer's higher priced shares for the target's lower priced shares. So after the merger, the earnings of the combined firm are simply the sum of the respective earnings prior to the merger. However, by purchasing a firm with a lower PE ratio, the acquiring firm is essentially exchanging higher priced shares for lower priced shares. So as a result, the number of shares outstanding for the acquiring firm increases, but at a ratio that is less than 1 for 1 because they are going to make this uh, scenario occur with higher valued shares against lower valued shares. So let's consider an example here. So we have an example right here. So here the acquiring company is denoted with A, the target company is denoted with T, and the post-merger company, that means when A acquires T, that company is denoted as A star. So the stock price of A is 100, earnings per share is $4 per share, P ratio is 25, total shares are 100,000, total earnings are 400,000, market value is $10 million. And when it comes to target company, you can see stock price is half of the acquired company, EPS is also lower, PE is also lower, but not significantly. Total number of shares, again lower. Total earnings are also lower. Market value of equity are also considerably lower than the acquired company. So let's do a calculation right here. So I will open up my notepad. Okay, so let's calculate the total earnings first. So total earnings, we have 400,000 from acquiring company and 250,000 from the target. So the total earnings is going to be $650,000. So that is clear. Then the combined market value. So we have 10 mil from the acquiring company and 2.5 from the target company, which leaves us with 2.5 million, right? And then the total number of shares. So let me go back to the slide quickly. So total shares outstanding. Oh, I'm sorry. I think I have miscalculated the total earnings aspect of this. This should actually be 125,000, right? Yeah, let me correct those up. So it would be 525,000, and market value is going to be 12.5 million. 12.5, that is also done. And then the total shares outstanding going to be 100,000, and then we have 50,000 here. So then what we are going to do is in as a result of this transaction, we need to then calculate the EPS. I think what this slide has done for the total share outstanding is not seem to be correct, because now we have the total share outstanding for 125,000. Oh, sorry. Yeah, I get what they have done now. So this is going to be less than 1 to 1, right? So as you can see, that is stated right here. The number of shares outstanding for the acquiring firm increases, but at a ratio that is less than 1 for 1. So this is 100,000, this is 50,000, but within the acquisition of it, you can see the PE ratio of the acquiring firm is higher than the target firm. So as a result, so this doesn't necessarily provide us with enough information to come into this value, but as a result, the total shares outstanding seem to be lesser than the actual summation of the shares, which should be 150,000, but it is 125,000. So if we move into the overall earnings per share, then this should be 525 divided by the number of shares, which is 125,000. So I think the amount that was mentioned in the uh, slide was clear. I think it was $4.20. So you can see the combined share price has been updated with the Yes, let's go back. Yes, so combined share price has been increased, but since the PE ratio is lower in the target company compared to the acquired firm, it has been not substantially increased, and which is also quite evident with the increase of the total shares outstanding. So that is a quite a simple example. I was a bit confused because the example does not provide us with enough information to understand uh, the increase of the total shares outstanding to be 125,000. But apart from that, you can see bootstrapping earnings is essentially the effect of bootstrap effect happened when the higher PE firm with the higher growth potential and higher market value has acquired the lower PE ratio with low growth prospect. And then we come into mergers and industry life cycle. So this is going to explain the different types of mergers and their motivations vary across different stages of an industry's life cycle. So understanding this relationship helps in evaluating why companies merge and what benefits they seek at various stages of the development. So here we start with the pioneering development stage. So in this stage, you are unsure of the acceptance of your product, you have large capital requirements, and you have low profit margins, which is evident with here. So the unsure of product acceptance is also replicated with the lower level of demand, larger level of capital requirement, and as a result of all of this, you are going to expect a low rate of profit. And the motivations for a merger at this stage would be to essentially to gain access to capital from more mature business. So at the same time, you would expect to share the management talent of a more matured entity as well. So in this stage, you would often see conglomerate mergers where diversification into new markets and products is acquired, and horizontal mergers where you combine with competitors to increase market presence. So a great example would be in early stages, Amazon acquired various companies to gain access to technology and management talent, such as the acquisition of Junglee Corp and Plantol in 1998, which helped Amazon enhance its e-commerce platform and expand its market reach. And then we come into the rapid growth or the accelerating growth stage. So in this case, you are now out of the unsure product stage, and now your products are attracting demand from the customers, and then as a result you are going to gain higher profit margins, sales and earnings are going to be rapidly increased, and the competition is at this stage is still a bit low. Competition is also a bit low, and here major motivations for the merger is gain access to capital, because you are in a rapidly growth stage, so it would make sense to invest your company in this level, and also it would expand your capacity to grow as well. And in this stage also, we would often see conglomerate and horizontal type of mergers. One of the famous examples is this is all you all know about this, Facebook's acquisition of Instagram. So during its rapid growth phase, Facebook acquired Instagram in 2012 for 1 billion to expand its user base and leverage Instagram's photo sharing technology, enhancing its growth trajectory. And then you come into the mature stage. So when you come into a mature stage, you have now a lot of competition, but still you can have opportunities for above average growth from this level that you are in. So in this stage, your motivations to merge are increase operational efficiencies and achieve economies of scale and synergies, because now you anyway earn high profits. Now you anyway have a certain level of demand, which has led you to have this mature level of growth. So in this level, you would see horizontal mergers, but you will see vertical mergers as well, because it would control more of the supply chain and it would also decrease costs. So when Google acquired Motorola in 2012, so this was during Google's mature growth phase to enhance its hardware capabilities and strengthen its Android ecosystem, achieving operational efficiency, because at that level Google's Android ecosystem was also functioning well, but it needed a hardware boost to compete against iPhone and iOS. So Motorola, being one of the pioneers in hardware, mobile hardware, and acquiring them was a smart move at that time. And then we come into the stabilization and market maturity stage. So in this case, competition has reduced the growth potential of the company, and you would have now capacity constraints. So motivations to merge here are to achieve economies of scale and then reduce cost, because you are facing a competition, and that competition has resulted in reducing your growth, and also improve management to make sure that you will be staying in the stabilization level for quite some time. So in this case also, you would expect horizontal and vertical mergers to happen. One of the examples is when AT&T acquired the Time Warner for $90 billion dollars to combine its distribution capabilities with Time Warner's content creation, aiming to streamline operations and reduce cost in maturing market. Then finally, after all these glory years, you would come to your declining stage, and in here, consumer tastes are going to shift from your product, and you would have shrinking profit margins as well. So the major motivation in this case is going to survive however long as you can, and then while surviving you would also expect to achieve operational effectiveness and efficiency by having a merger. And also, since you are in a declining stage, you would often look for somehow level of a growth opportunity as well. So in this scale, you would see horizontal, vertical, and conglomerate mergers. Another example here would be Sears and Kmart merger in 2005. So in 2005, Sears and Kmart merged to form Sears Holdings, where the aim was to survive in a declining retail market by combining their resources and attempting to achieve operational efficiencies. So throughout these different industry life cycles, we can identify that mergers are whatever the life cycle stage you are in, your company is in, it is going to be a strategic move that can provide significant benefits depending on the stage of the industry life cycle. So, from gaining access to capital and management talent in the early stages to achieving operational efficiencies and survival in the declining stage, understanding the motivations behind mergers would help stakeholders evaluate their strategic fit and potential benefits. So, by examining these real life examples I was going for each of these stages, we can see how these theoretical concepts are applied in practice, offering valuable insights into the complex dynamics of corporate mergers and industrial evolution. Then we come into the different characteristics of different forms of acquisition. So we have two basic forms of acquisition. First one is stock purchase and the second one is asset purchase. So each form has distinct characteristics regarding payment, approval, corporate taxes, shareholder taxes and liabilities. So let's examine each one of these things. So let's start off with stock purchase. The payment side, when it comes to a stock purchase, in the payment, the acquirer makes the payments directly to the target company's shareholders in exchange for their shares. So when Facebook acquired Instagram, they paid $1 billion in cash, all right, in cash and stock directly to Instagram's shareholders. Then comes approval. So a majority of the target company's shareholders must approve the transaction if it is a stock purchase. So when the acquisition of WhatsApp by Facebook happened for $20 billion, the approval of WhatsApp's shareholders was necessary to finalize the deal. And then corporate taxes. There are no immediate corporate tax implications for acquiring company in a stock purchase. So when Google and YouTube had that deal in 2005, Google didn't face immediate corporate taxes as it was a stock purchase. Then comes shareholder taxes. Shareholders of the target company would pay a company capital gain tax on the sale of their shares. So shareholders who sold their shares in LinkedIn during its acquisition by Microsoft in 2016 would have paid capital gains on their profits. And then comes liabilities. The acquiring company assumes all liabilities of the target company, including debts and legal obligations, if it is a stock purchase. So when JP Morgan acquired Bear Stearns in 2008 under the financial crisis, it assumed Bear Stearns' liabilities, including its toxic assets, which were significantly hindered in its performance due to the rapid impact of the declining real estate market at that time. So that's the nature of a stock purchase. And now let's focus on an asset purchase. So compared to stock purchase, in an asset purchase, payments are made directly to the target company for its assets compared to the uh, direct cash payments happened in a stock purchase or direct stock payments. So when Google acquired the Nest Labs for $3 billion, the payment was made directly to Nest Labs for their assets. And when it comes to the approval under an asset purchase, shareholder approval is generally not required unless the asset sale is substantial. So we already spoke about Google's acquisition of Motorola. So in this case, only Motorola's board needed to approve the sale, not the individual shareholders, since it was considered a substantial asset sale. And corporate taxes, the target company is responsible for paying capital gain taxes on the sale of its assets. So when Pfizer sold its nutrition business to Nestle, Pfizer had to pay capital gains tax on the proceeds from the sale because it was an asset purchase. And then comes the shareholder taxes. So there are no direct tax implications for the shareholders of the target company in an asset purchase. So in the case of an asset sale, shareholders of the target company, for example, General Electric sale of its appliance divisions to Haier, do not directly incur taxes from the sale. And finally, liabilities. In a case of an asset purchase, the acquiring company usually avoids assuming the target company's liabilities. Instead, it acquires only the assets specified in the purchase agreement. So when IBM acquired the assets of the weather company, it avoided taking on the weather company's liabilities, focusing solely on the strategic assets like weather data platform. So you can see on five different fronts, stock purchase and asset purchase are differed to each other. So understanding the differences between stock purchases and asset purchases is crucial for evaluating acquisition strategies. So stock purchases involve acquiring shares directly from shareholders and assuming all liabilities, while asset purchases involve buying specific assets directly from the company, often avoiding liabilities. So each method here, stock purchase, whether it is stock purchase or an asset purchase, each method has unique tax implications and approval requirements that significantly impact the transaction structure and financial outcomes. Real life examples such as Facebook's acquisition of Instagram, which is a stock purchase, Google's acquisition of Nest Labs, which is an asset purchase, illustrate how these principles are applied in practice, providing valuable insights into strategic acquisition decisions. And then we are going to focus on the method of payment under the transaction characteristics. So when it comes to mergers and acquisitions, the method of payment is a crucial aspect that can significantly influence the structure and outcome of the transaction. So there are three primary methods of payment: cash offering, securities offering, and mixed offering. And each method has different implication for both the acquirer and the target company. So, what is cash offering? Cash offering involves the acquirer paying the target company's shareholders a specific amount of money per share in exchange to their shares. So, in 2017, when Intel acquired the Mobileye for approximately $15.3 billion dollars in cash, Intel paid Mobileye shareholders, I think, $63 per share in cash, which would lead to securing the acquisition entirely through a cash transaction. So this method provided immediate liquidity to mobilize shareholders. And then comes a securities offering. So a securities offering involves the acquirer offering its own shares to the target company shareholders in exchange for their shares. So this method requires determining an exchange ratio and calculating the cost based on the number of shares and the value of the stock. So exchange ratio, that would be the number of shares the acquirer stock offered per share of the target company's stock, and the cost would be exchange ratio into number of shares of target into value of stock given to the target shareholders. So in 2006, AT&T acquired BellSouth in a securities offering. Here, AT&T offered, I think, roughly 1,500 shares of its stock for each BellSouth share. So this exchange ratio helped AT&T integrate BellSouth without a significant cash outlay, distributing risk and reward between both sets of shareholders. And now comes the mixed offering. So mixed offering is a combination of both cash and securities as payment to the target company's shareholders. So this method balances the immediate liquidity provided by cash with the potential future value offered by shares. So a prime example for this is when Disney acquired 21st Century Fox in 2019. So the deal was structured as a mixed offering, and Disney paid 70 odd billion dollars consisting of both cash and shares. And doing that allowed Disney to provide immediate value to Fox shareholders while also integrating them into Disney's future growth prospects through stock ownership. And then comes the attitude of target management. So the attitude of the target company's management toward a merger offer significantly impacts how the merger process unfolds. The merger can be classified as either friendly or hostile based on how the target company's management reacts to the offer. So let's outline the characteristics of both friendly and hostile mergers, which would lead to some of the favorite examples of defense mechanism, which I want you to focus on. So the initial stage involves with the negotiation if it is a friendly merger. So this would be characterized by cooperation between the management teams of the acquiring and the target companies is quite substantial and ultimately lead to the name friendly merger. So at the negotiation stage, it involves discussions between the acquirer and the target company to agree on the terms of the merger. So when Dell was acquiring EMC in 2015, the deal was negotiated in a friendly manner, with both management teams working together to reach an agreement that benefited both the parties, as it should have been in a friendly merger. And then due diligence. So once preliminary terms are agreed upon as a result of the negotiation stage, the acquirer conducts due diligence to thoroughly investigate the target company's financials, operations, and their legal matters at hand. So if you are going to acquire the company without any trouble, then you need to have a due diligence to make sure that your financials and your operational efficiency outputs, everything needs to be in order. So when Amazon was acquiring Whole Foods in 2017, Amazon conducted extensive due diligence to ensure they understood Whole Foods business operations, financial health, and potential liabilities. Then the definitive merger agreement. So after successful performance of due diligence, a definitive merger agreement is drafted outlining the final terms and conditions of the merger. So the agreement between Disney and 21st Century Fox in 2019 included detailed terms about the acquisition, regulatory approvals, and the integration process. And finally, proxy statement. What is a proxy statement? Material facts and details about the merger are provided to shareholders in a public document called a proxy statement. This would enable them to make an informed decision. So I spoke about the Exxon and Mobil merger earlier, ExxonMobil, which was proposed in 1998. A proxy statement was issued to shareholders detailing the benefits and strategic rationale of the merger, ultimately leading to shareholder approval. So you can see at each step of a friendly merger, at every stage, proper conversation and proper communication happens with the acquirer and the target companies. The due diligence is performed, a proper agreement, proper terms and conditions are met by both the parties, and the decision is properly informed to the shareholders. So, friendly merger, you can see everything is good and essentially can be called as a happy path when it comes to acquisition or mergers of two companies. And then we come into hostile merger. So hostile merger occurs when the target company's management opposes the merger offer. So the acquirer may resort to more aggressive tactics to pursue the merger. And here we have three key methods a hostile merger would take place: a bear hug, tender offer, and a proxy fight. So what's a bear hug? The acquirer bypasses the target company's CEO and directly presents the merger proposal to the board of directors, often making the offer public to pressure the board into considering it. So in 2008, Microsoft actually made a bear hug to acquire Yahoo by directly approaching Yahoo's board with a bid of 44.6 billion bid, despite the management's initial resistance. So a bear hug would be you would directly skip the CEO and directly approach the management board or the director board, and often you would publicize this information so your own shareholders would have pressure on the director board. And then comes the tender offer. So here the acquirer makes a public offer to the target company's shareholders to buy their shares at a specified price, usually at a premium to the market price, to gain control of the company. So here, an example here would be in 2016, Bayer made a tender offer to Monsanto's shareholders, to reputed PLCs, offering $128 per share in an attempt to acquire the company, which Monsanto initially resisted but later accepted. And then you have proxy fight. Here, the acquirer attempts to take control of the target company by persuading shareholders to vote out the existing management and board members in favor of those who support the merger. So, Carl Icahn, a prominent activist investor, often engages in proxy fights to replace company boards with directors who support his strategic plans. So in 2013, he led a proxy fight to influence Apple's board regarding capital allocation and share buybacks. So you can see the attitude of target management plays a crucial role in shaping the merger process. So friendly mergers, as we have discussed, they involve cooperative negotiations through thorough due diligence and clear communication with shareholders, often leading to a smoother integration and mutual benefits. But on the contrary, hostile mergers involve more aggressive tactics such as the bear hugs, tender offers, and proxy fights that we have discussed. And this would lead to reflect the acquirer's determination to gain control despite the opposition by the target company. So understand these dynamics would actually help stakeholders navigate the companies of mergers and acquisition transactions, ensuring strategic alignment and maximizing value creation. So now with this overall introduction into the different types of mergers of friendly merger and hostile merger, I want to go over different defense mechanism companies, target companies would take upon under a takeover. So we have pre-offer takeover defense mechanisms and we have post-offer takeover defense mechanisms. So I would highly encourage you to go over the different cases I'm going to tell you about, their meaning and real life examples, because this would be one of the key areas that I really want to test out in the upcoming exam. So I highly encourage you to go over these slides, the information I am explaining to you, I am lecturing you on, and take some notes in this section, both pre-offer takeover defense mechanisms and post-offer takeover defense mechanism, because these are quite interesting and things that actually happened in real life. So I want you to take down some notes and understand the actuality of these mechanisms, and also understand how they would impact the overall value of the firm, even the merger happens or not, or particularly it happens uh, even after the deployment of the defense mechanism. So let's take an introduction to the pre-offer takeover defense mechanisms first. So, in the context of mergers and acquisitions, companies often employ various defense mechanisms to thwart hostile takeover attempts. So, these are categorized into two areas: pre-offer takeover and post-offer takeover. So, each with unique strategies to protect the target company from being acquired against its will. So, we are going to start up with poison pill. Poison pill allows the target company to issue new shares to existing shareholders at a substantial discount, making it prohibitively expensive for the acquirer to gain control. So there are two poison pill types: flip in pill and flip over pill. So flip in pill is target shareholders can buy additional shares of the target company at a discount, diluting the ownership interest of the acquirer. While flip in pill works like that, flip over pill works where target shareholders have the right to buy shares of the acquiring company at a significant discount after the merger. So in 2012, Netflix adopted the poison pill strategy to prevent a hostile takeover by Carl Icahn. So, by allowing shareholders to purchase additional shares at a discount, Netflix made it financially challenging for Icahn to gain a controlling interest. Then we have poison puts. Poison puts provide bondholders with the option to demand immediate repayment of their bonds if there is a hostile takeover, creating a financial burden of the acquirer. I was going to highlight the keyword bondholders. So earlier in the poison pill, it was about issuing new shares to existing shareholders at a discounted price, and poison puts is providing bondholders with the option to demand immediate repayment of their bonds in a hostile takeover. So, in 2000s, Kroger, which is a supermarket chain, included a poison puts in their bond agreement, giving bondholders to having the right to demand early repayment in the event of a takeover, thereby discouraging potential hostile bids. Because if majority of your bondholders are going to request or they want to be repaid for their bond amounts, then you are going to be a less and less desirable prospect to the acquirer who's going to take over you in a hostile manner. Then we have restrictive takeover laws. So what this means is companies may seek to reincorporate in states with stringent anti-takeover laws to make hostile acquisitions more difficult. So in the context of United States, many companies choose to incorporate in Delaware, which has a robust laws that provide significant protection against hostile takeovers, including statutes that restrict certain business and combinations. And then you have a staggered board. A staggered board structure divide the board of directors into multiple groups, each elected for staggered terms, typically 3 years. So this would make it difficult for an acquirer to gain immediate control of the board. So this has happened with Yahoo, where they employed a staggered board structure, which made it challenging for activist investors or potential acquirers to replace the entire board quickly and take control of the company. And then we move into restricted voting rights. So, this defense mechanism triggers a loss of voting rights for shareholders who own equity above a certain threshold, for example, 50% or 20%, unless approved by the board of directors. So, in the 1980s, one of the famous United States Airlines, TWA, implemented restricted voting rights to prevent hostile takeovers by Carl Icahn, ensuring that any large share purchases would not automatically translate into voting power. And then supermajority voting provision for mergers. So this provision requires a supermajority. For example, 70% or 80% of shareholder votes to approve a merger, making it more difficult for hostile acquirers to succeed without overwhelming support. So unless you have the overwhelming majority approves the merger that's going to happen, it would be extremely difficult task for the acquirer to uh, process with the merger. So Jones Manville Corporation, which was a building materials company, they used a supermajority voting provision to protect itself from hostile takeover attempts, requiring a higher threshold of shareholder approval for any merger. And then you have golden parachutes, again another famous example, a famous defense mechanism. So, golden parachutes are lucrative compensation agreements for senior management that activate upon termination following a takeover. So, these agreements make the company less attractive to potential acquirers due to the high cost of the payouts. So, when Yahoo was facing these potential acquisition attempts, its executives had golden parachute agreements that promised significant payouts, therefore discouraging hostile bidders due to the high severance costs involved with paying their senior managers. And then you have fair price amendment. A fair price amendment restricts mergers unless a fair price is offered to current shareholders as determined by a formula or independent appraisals. So many companies like fast food giant McDonald's have adopted fair price amendments to ensure that any acquisition offers must meet a minimum price threshold, protecting shareholders from being forced to sell at unfairly low prices. So you can see pre-offer takeover defense mechanisms are critical tools that companies use to protect themselves from unwanted acquisition attempts. So these strategies, ranging from poison pills and staggered boards to restricted voting rights and golden parachutes, would create financial and administrative barriers that make hostile takeovers less appealing or less feasible. So understanding this mechanism would help the stakeholders to appreciate the complexities of corporate defense strategies and the lengths to which companies may go to maintain their independence. And that would be the different cases for pre-offer takeover. So I, as I stated earlier, also you need to understand what each of these methods say because they are easy to understand. Their examples are easy to understand. So even if I provide you with an example, it would be better you can identify, okay, this is a poison pill, this is a poison put, this is what happens during a poison pill, this is what happens during a poison put, this is how the overall value of the company is going to be determined if a poison pill is executed. This is how the overall value of a company is going to be determined if a poison put is executed. So that level of understanding is what I would expect from you by studying this section, and it would be a good preparation for your exam as well. So following the similar structure, we now come into post-offer defense mechanisms. So this is come into place once a hostile takeover has been made. So once it is been made, the target company can employ several defense mechanisms to thwart the attempt. So these strategies aim to make the acquisition less attractive or more difficult for the acquirer. So let's explore these post-offer defense mechanisms in detail. First, we have the just say no defense. So in here, the target company's management and board can publicly reject the offer and explain why it is not in the best interest of the shareholders. So this aims to convince shareholders to reject the offer as well. So a company called PeopleSoft in 2004 used this just now defense against Oracle's hostile takeover bid, arguing that the offer undervalued the company and was not in the shareholders' best interest. Litigation is a very harsh action that you can take and also a costly action, which is basically the target company can initiate legal action to delay or block the takeover, often challenging the legality of the acquirer's tactics or the adequacy of the offer. So in 1999, Monsanto sued to block a hostile takeover bid from American Home Products, alleging that the offer violated antitrust laws. Then you have Greenmail. Greenmail involves the target company repurchasing its own shares from the hostile acquirer at a premium to the market price, effectively paying the acquirer to abandon the takeover attempt. So one of the famous rubber companies in the US, Goodyear Tire and Rubber Corporation, use this method to buy back shares from Sir James Goldsmith, who had accumulated a significant stake in the company, thereby preventing a hostile takeover. Then you have stock repurchase. Here, the target company buys back its own shares from the open market, reducing the number of shares available and increasing the percentage of ownership held by friendly shareholders. So, this has happened in 2005 for SAS Airlines, where they announced a share repurchase program to fend off a hostile bid from another airline group, aiming to consolidate ownership among supportive shareholders. Then you have leverage recapitalization. So here the target company takes a significant debt to finance a large share repurchase or pay a special dividend to the shareholders. So this would increase the company's leverage and make it less attractive to the acquirer. So in 1986, Dayton Hudson, which is now famously known as Target, used leverage recapitalization to fend off a hostile takeover by the Dart Group in US, issuing a special dividend and increasing its debt load. And then you have another famous post takeover defense mechanism, which is the crown jewel defense. So here the target company sells off its most valuable assets, basically the crown jewels of the company, most significant assets of the company, to a friendly third party to make itself less attractive to the hostile acquirer. So again, another example here I have found by researching when Martin Marietta, the one of the mining entities in US, faced a hostile takeover by Bendix Corporation. They sold their uh, mining and aerospace segments of their overall business venture to Lockheed Martin, one of the largest defense manufacturers in United States, making itself less appealing to Bendix. And then you have Pac-Man Defense. So I'm sure you have played Pac-Man or seen Pac-Man, so you know how Pac-Man would eat, right, with their staggering mouth. So in this Pac-Man defense, what the target company does is they turn the tables by making a counter offer to acquire the hostile acquirer. So this aggressive tactic is named after the Pac-Man video game because the way it eats its enemies, right? You know, its mouth goes up, down as the aggressively try to eat the enemies. So likewise, the target company uh, now would come to buy back the acquiring company, right? So it's like that meme saying, the famous meme saying, call an ambulance, but not for me. So in this case, it is exactly like that, where the acquiring company comes to the target company trying to acquire it, but in an unexpected turn, the target company going to aggressively buy the shares of the acquiring company, make the process a completely debacle and leading to the culmination of the acquisition. And then come the White Knight defense. So here the target company seeks a more friendly company, which is the White Knight here, to acquire it instead of the hostile acquirer. So White Knight would offer a better deal for the shareholders and management. So HP, famous laptop company, Hewlett Packard, acted as a White Knight by acquiring Compaq, which was under the threat of a hostile takeover from Dell Technologies. And finally, we have White Square Defense. So here the target company finds a friendly third party, which is the White Squire, to buy a significant minority stakes of the company. So the White Squire does not seek control, but helps blocks the hostile acquirer from gaining a majority stake. So in 2000, when Air Canada faced a hostile bid from Onex Corporation, they turned to Canadian Airlines, which took a minority stake, helping to block the takeover. So I think you can understand the difference between a knight and a squire. So a knight is the more prominent figure compared to a squire. Squire is basically the servant of a knight. So in the white knight defense, they would acquire the entire target company instead of the hostile acquirer. But in a White Square defense, they would not basically acquire the target company, but they would buy a minority stake big enough to block the hostile acquirer from gaining access to a majority stake. So I think these would be two interesting examples of the same concept being on two different dimensions. So similar to pre-offer defense mechanisms, post-offer defense mechanisms are also crucial strategies that a target company can employ to protect itself from hostile acquisition attempts. So these strategies ranging from just say no to more aggressive tactics like leverage recapitalization and greenmail provide the target company with multiple avenues to make the takeover less appealing or more challenging for the acquirer. So understanding these defense mechanisms would help stakeholders navigate the complex landscape of hostile takeovers and appreciate the strategic maneuvers involved here, same as with the pre-offer takeover defense mechanisms as well, depending on the circumstance the target firm is going to face upon. All right, let's now move into the uh, regulations, and particularly let's focus on the antitrust laws associated with mergers and acquisitions. So, mergers and acquisitions are subject to various regulations aimed at maintaining fair competition and protecting the interest of shareholders. So, here we are going to cover two critical aspects: antitrust laws and securities laws. So, antitrust laws are designed to prevent mergers and acquisitions that could impede competition in the marketplace. Regulatory bodies such as the Federal Trade Commission in the United States closely examine the potential impact of a merger on market competition. So a key indicator or a key tool they use is the analysis of Herfindahl-Hirschman index or the HHI index. So the HHI index is a measure of market concentration, and it is calculated by summing the squares of the market shares of all firms in the market. So you can see the formula is given right here. Here sum to the n of I equals 1, MSI into 100 squared. So MSI is the market share of firm I, N is the total number of firms in the market. So then we have the different concentration level on the HHI. So if it is less than 100, then it is market is not concentrated. Any amount of change is typically not subject to regulatory action. Then if the HHI index resulted with 1000 to 1800, then it is moderately concentrated. That means possible changes if the merger significantly increases HHI. And if it is more than 1800, then it is highly concentrated. Mergers that result in significant HHI increases uh, are likely to face regulatory challenges. So let's focus on this particular example right here. So here there are 20 firms in the industry. Each has 5% market share. Firms 19 and 20 are going to merge, and here we are required to calculate the pre-merger and post-merger HHI and discuss the likelihood of an antitrust challenge. So pre-merger HHI is going to be 5% into 100 into 20 because of the 20 firms in the industry, that is 500. And post-merger HHI, again 5% of the market share into 100 squared. Now this time multiplied by 18, the reason being uh, now firms 19 and 20 are going to merge themselves, and also now the market share for each of the firms are going to be increased, which is 1% for the merging shares, sorry, 10% for the merging shares because they have merged, their market share has been merged together, and their square is also need to be calculated, and the summation of these two instances is going to be 550. So since the post-merge HHI is 550, which is less than 1000, then this market is not considered to be concentrated and antitrust challenge is unlikely to happen. And then we come into the securities laws. So we discuss about the antitrust laws and the HHI indicator the different entities would use. So when it comes to securities laws, they aim to ensure fairness and transparency in financial markets, particularly during mergers and acquisitions. So these laws require public disclosure of significant changes in ownership and other material information that could affect investors' decisions. So one of the famous regulatory acts which is used under the securities laws is the United States Section 13D of the Williams Act. So this section mandates that any party acquiring 5% or more of a company's shares must file a public disclosure with the Securities and Exchange Commission of United States, and this disclosure includes information about the acquiring party's intentions, the source of the funds used for the purchase, and the other relevant details. So in a conclusion of these antitrust laws and securities laws, we need to understand that regulatory scrutiny is a critical aspect of a merger and acquisitions, where with antitrust laws ensuring that market competition is preserved and securities laws would maintain fairness and transparency in financial markets. So under antitrust laws, we have discussed about the Herfindahl-Hirschman index or the HHI index. That is a key tool which is used to assess market concentration and the potential competitive impact of a merger. And when it comes to securities laws such as the Williams Act, which we have just discussed, it requires public disclosure of significant ownership changes, promoting transparency and investor confidence. So that would be the understanding of the antitrust laws and securities laws. And then you have the target company valuation. You already know about different valuation methods that's going to be adopted here. So let's discuss these one by one, starting from the discounted cash flow analysis. So discounted cash flow analysis, I feel like I'm repeating it again and again when it comes to DCF, but I will quickly go over. So as you would all know, DCF is a fundamental valuation method used to estimate the value of an investment based on its expected future cash flows. So this method is widely used in mergers and acquisitions to determine the intrinsic value of a target company. So let's go forward with identifying the target company's valuations using DCF and what are the advantages and disadvantages. So, first advantage would be the model expected changes in cash flows. So, DCF allows for the incorporation of expected changes in the target company's cash flows, such as operating synergies and cost structure changes that may result from the merger. So, I stated earlier about the Disney's acquisition of Pixar. So, here, if you were to use DCF model, It can be used to project future cash flows, including synergies from integrating Pixar's creative talent with Disney's distribution channels. And when you use DCF, it provides interesting value estimate, which is the second advantage. So DCF method would offer an estimate of the target company's intrinsic value based on forecast fundamentals, providing a detailed insight into the company's true wealth. So when Google was acquiring YouTube, if DCF was used to calculate the valuation, you can see that if it was used to determine the intrinsic value of YouTube's projecting advertising revenues and user growth, and then the customization and modification. So assumptions and estimate in the DCF model can be adjusted and modified to reflect changes in the target company's operations or market conditions, allowing for a more tailored valuation specified for the target company's nature and the overall acquisition's nature. For example, if you focus about the acquisition of LinkedIn by Microsoft, if the DCF model was used, it can be customized to account for LinkedIn's anticipated growth in premium subscriptions and advertising revenues. So while these advantages are in place, there are some disadvantages when it comes to target company valuation using the discounted cash flow. And now let's dive into them. First disadvantage is going to be the challenge with non-aligned free cash flows. So, discounted cash flow can be difficult to apply when the target company's free cash flow do not align with profitability, particularly in the initial stages. So, for example, if startups with high initial investment cost and delayed profitability can present challenges for DCF valuation, as seen in early stage valuations of companies like Uber or Tesla. And then you have the uncertainty in long-term cash flow estimate. So estimating cash flows far into the future is inherently uncertain and can introduce significant risk into the valuation if you are going to adopt DCF into target company valuation. For example, predicting long-term cash flows for technology companies like Apple or Amazon can be quite challenging due to the rapid changes in technology and market dynamics. And then you have the variability in discount rates. So the estimates of discount rate, the value for R, which are used to calculate the present value of future cash flows, can change over time due to shifts in market conditions, interest rates, and company risk profiles. So, for example, the discount rate for Facebook's valuation, it could fluctuate based on changes in the macroeconomic environment and perceived risk in the overall technology sector. And finally, the sensitivity when it comes to the terminal value estimations. Terminal value is a key part of the discounted cash flow. You all know that. So terminal value would represent the value of the company's cash flow beyond the forecast period. So this is a highly sensitive value because of the assumptions made, such as the growth rate and the discount rate. So if you were to value a retail giant like Walmart or Target, minor changes in the terminal growth can significantly alter the overall valuation, demonstrating the sensitivity of the terminal value in discounted cash flow analysis. So with these advantages and disadvantages from discounted cash flow valuation under target company, we come into the comparable company analysis. So similar to relative valuation. So we spoke about this briefly in our private income lecture as well. So comparable company analysis or the CCA is a popular method used in valuing target company during mergers and acquisitions, and this involves comparing the target company to similar publicly traded companies to determine the value. So let's go through these steps one by one. So first one is define a set of comparable companies. So first you need to identify a group of companies that are similar to the target company in terms of size, industry, growth prospects, and operational characteristics. So these companies should be publicly traded to have accessible financial data. For example, if valuing a mid-sized tech company, you might select similar tech firms of comparable size and market presence, such as those within the same industry sector and geographic region. Then comes the calculate relative value measures. So here you need to calculate valuation multiples for these comparable companies, and common multiples are presented right here. Enterprise value to earnings before interest and tax, price to cash flow, price to sales, price to earnings, price to book value. All these right here. So these multiples help determine what the target company should be valued at based on how similar companies are currently trading. So for example, if the average PE ratio of comparable companies is 15 and the target company's earnings per share is $2, the target company's estimated value would be $30 per share, which is basically 15 into $2. And then determine the takeover premium. So the takeover premium is the amount by which the acquisition price exceeds the current stock price of the target company. So it compensates shareholders for selling their shares and losing future benefits. So in percentage terms, you can see this is presented right here. The uh, premium is calculated into DP minus SP divided by SP. So DP is the deal price and SP is the stock price. So the difference between deal price and the stock price calculated against the stock price is how the premium is going to be presented. And similar to the discounted cash flow valuation in the target company valuation, let's discuss the advantages and disadvantages when the comparable company analysis is used as well. The first advantage of using comparable company analysis for target company valuation is the reasonable approximation of value. So this method would provide a reasonable approximation of the target company's value relative to similar companies in the market. For example, if you are going to value a retail company like Target by comparing it to similar companies like Walmart and Costco, it's going to be more accurate. And then the readily available data. So most of the required data, such as financial statements and market prices, are publicly available for the comparable companies because if you remember, we are going to take the similar companies mostly on public companies. So data for companies listed on stock exchanges can be easily accessed through financial databases like Bloomberg, Reuters, or Yahoo Finance. And then market derived estimates. So, unlike the discounted cash flow method, where estimates are derived from internal forecast, comparable company analysis uses market derived multiples, reflecting current investor sentiment and market conditions. For example, using the PE ratio of tech companies like Apple, Microsoft, and Google to value a similar tech firm is a prime example for this. However, having all these advantages, it's also succumbed into certain disadvantages as well. First one would be the sensitivity to market mispricing. So, if you are going to use comparable company analysis, it is sensitive to market mispricing of comparable companies. So, if the market overvalues or undervalues the comparable firms, the valuation of the target company could be inaccurate. So, during the tech bubble in the 1990s, overvalued tech stocks could lead to an inflated valuation of the target tech company. That is a prime example for this. And then you have the difficulty in incorporating specific plans. So it is challenging to incorporate specific plans or strategies of the target company, such as new product launches or strategic shifts, which might affect its future performances. For example, a pharmaceutical company with a new drug in the pipeline may not be accurately valued if the comparable companies do not have similar growth prospects. So you might think even both the industry or both the companies are in the same industry, both are in the pharmaceutical industry, but if one company is going to come up with a revolutionary result, then if you are going to make your valuation based on a similar company which does not have a prospect like that, then your valuation is not going to result accurately because your growth prospect is not adopted into the overall valuation. For example, if you would take Pfizer or an average against an average um, a pharmaceutical company in the COVID era, then your valuation in the Pfizer is not going to be accurate because Pfizer was heavily invested in developing a drug against COVID, which was massive at the time. So you can understand how this could be coming up with a considerable disadvantage if the comparable company analysis method was to use at such instances. And then another disadvantage is the need for additional premium estimation. So if you were to use comparable company analysis, it would yield a market estimated fair stock price, but analysts must estimate a fair takeover premium separately, and this would add complexity and potential for inaccuracy. For example, estimating an appropriate takeover premium for a company undergoing significant operational changes is going to be a difficult task. And then you have the timeliness and accuracy of data. So, data for past premiums may not be timely or accurate for the particular target company under consideration, leading to potential valuation discrepancies. For example, using outdated takeover premium data from a different market cycle may not reflect the current condition the target company is going to face or the target company is currently facing right now. And here we come into the comparable transaction analysis. So we discussed the uh, First type of target company valuation, discounted cash flow analysis. We analyze this with its advantages and disadvantages. Then we discuss the process of conducting comparable company analysis. And finally, we come into comparable transaction analysis. Here also we are going to focus on the advantages and disadvantages. So, as an advantage, uh, uh, target company valuation under the comparable transaction analysis, uh, it involves analyzing recent transactions of similar companies to determine the value of the target company. So, one key advantage is no need for separate takeover premium estimation because under the comparable transaction analysis or CTA, the takeover value estimate inherently include the takeover premiums as they are derived from actual transaction prices. So this would simplify the valuation process. So to highlight how easy it's going to be, it estimates inherently include the takeover premium. So, for an example, when evaluating LinkedIn's acquisition by Microsoft, analysts can refer to the transaction price of similar acquisitions such as Facebook's purchase of WhatsApp or Facebook's purchase of Instagram to understand the inherent premium. So, you would need to estimate it separately. Then you have the market established values. So the values come directly from recent established market prices, which would reflect the current market condition and investor sentiment. So, for example, for valuing a financial services firm, looking at recent acquisitions in the banking sector, such as JP Morgan's acquisition of VPay, would provide relevant and up-to-date market valuations. And also, if you are going to use comparable transaction analysis, there is a reduced litigation risk because using prices from recent transactions would essentially mitigate or reduce the litigation risk as the valuation is based on market established prices, not so much on estimated prices. So this can help in gaining approval from the board of directors and reducing disputes regarding the merger's transaction pricing. So for example, if a company like Pfizer is going uses certain pharmaceutical industry transactions to justify its acquisition price, it is less likely to face litigation from shareholders questioning the fairness of the deals. But having these type of advantages also come with a certain set of disadvantages as well, and let's now discuss them in detail. First one is the risk of inaccurate past takeover values because you are using historical transactions, right? So there is a risk that the real takeover values in the past transactions may not have been accurate or may have been influenced by unique circumstances, making them less applicable to the current valuation. For example, if we focus back into 90s tech bubble, if a tech company was overvalued during a market bubble, using its transaction price for current valuations could lead into inflated estimates, which is essentially not accurate. And then you have the lack of comparable transactions. So it is easier to say that if you would use historical transactions, it is easier to have a estimate the takeover premium, and it would be easier to avoid litigation risk, things like that. But uh, there may not be any recent comparable transaction to use for calculating the takeover value, especially in niche industries or for unique business models. So for example, if you are going to value a cutting edge biotechnology firm, it would be challenging if there have been few or no recent acquisitions of similar companies, similar biotechnology or technology related companies. And then you have difficulty incorporating specific plans. So the analysis may be inaccurate as it is difficult for the analyst to incorporate specific plans or strategic changes for the target company into the valuation. For example, a company planning a significant shift in business strategy or launching a new product line may not be accurately valued using past transaction data that does not reflect these future changes. So you can see both these three methods are good and well-renowned methods of conducting valuation for of a target company in an acquisition, but all three of them comes with their own set of advantages and disadvantages, and based on the situation, you would need to decide which method is going to be the most applicable or most appropriate one. All right, we come into next section, which is bid evaluation, post-merger value of an acquirer. So in mergers and acquisitions, the evaluation of bids is a critical process that involves determining the post-merger value of the acquirer as well as the gains accrued to both the target and the acquirer. So let's dive into what this actually means. So, in any merger that makes economic sense, the combined firm is expected to be worth more than the sum of the two separate firms, which is expected, right? So, if A and B going to merge, the output of C should be overcoming the value of A plus B. So that would be identified with the concept of synergy. So this additional value is derived from synergies, as I stated earlier, created by the merger and the cash paid to shareholders as part of the transaction. So the formula to calculate the post-merger value, you can see it right here. Uh, VAT equals VA plus VT plus S minus C. So VAT is the post-merger value of the combined company, acquirer plus target. VA, pre-merger value of the acquirer. VT, pre-merger value of the target. S is the synergies created by the merger. C is the cash paid to target shareholders. So let's consider a very simple example. So let's consider the merger between Disney and Pixar. So Disney's pre-merger value is 100 billion. Pixar's pre-merger value is 10 billion. Expected synergies from the merger is 5 billion. Cash paid to Pixar's shareholders was 7 billion. So post-merger value is going to be 100 billion is Disney's pre-merger value, then 100 plus Pixar's merger value, which is 10, 110, plus the expected synergies, which is 5 billion, then 115 billion minus the cash paid to Pixar's shareholder 7 billion. So 115 minus 7, it is going to be 108 billion dollars is the post-merger value of the combined company Disney and Pixar. So this would illustrate how the combined value is greater than the sum of the individual values due to the synergies realized from the merger. So essentially it should have been 100 plus 10 basically, but it is essentially associated with the synergies impacted as a result of the merging transaction. And then we have the gains accrued to the target. So in most merger transactions, acquirers must pay a takeover premium to entice the target's shareholders to approve the merger. So this premium represents the additional amount over the pre-merger market value of the target's shares that shareholders would receive. So the target's management will negotiate for the highest possible premium to maximize shareholder value. So here the equation is again provided. Gain is equal to TP is equal to PT minus VT. Gain is the gains accrued to target shareholders, which equals to the takeover premium. So this is calculated by price paid for the target minus pre-merger value of the target. So for an example, a company offers to acquire another company, let's say $120 per share, when the pre-merger share price was $100 and let's say the takeover premium is $20 per share. So the gain is going to be basically 120 minus 100, which is $20 per share. So you can see it equals the takeover premium as well. So this gain represents the additional value received by the target shareholders above the pre-merger market value of their shares. And then first we discuss the gain accrued to the target, and now we are going to discuss the gains accrued to the acquirer. So acquirers are also willing to pay a takeover premium because they expect to generate their own gains from any synergies created by the transaction. So the acquirer's gain is therefore equal to the synergies realized minus the premium paid to the target's shareholders. So their gain is S minus TP equals S minus PT minus VT. So S is the synergies created by the merger. TP is the takeover premium. PT is the price paid for the target. VT is pre-merger value of the target. So let's consider a simple example here. Let's continue the previous example. So in the previous example, I said that company offers to acquire another company for $120 per share when the pre-merger share price was $100 and the takeover premium was $20 per share. So if the synergies from the merger are valued at 5 billion and the takeover premium is $20 per share for 10 million shares, the total premium paid is also 200 million. The acquirer's gain can be calculated as, so 5 billion is going to be your uh, synergies created by the merger because synergies from the merger are valued at 5 billion as per the question. And then uh, your total premium is calculated with the uh, 200 million. The total premium paid is 200 million. So basically your gain to the acquirer is going to be 5 billion minus 200 million, which would be 4.8 billion dollars. So this shows that acquirer's gain is derived from the synergies minus the cost of the takeover premium paid to the target's shareholders. So This example is an essential identification of how both target and acquirer are achieving gains as a result of the merger conducted between the two parties. So, bid evaluation in mergers and acquisition would involve assessing the post-merger value of the acquirer and the gains accrued to both the target and the acquirer. So, by understanding these calculations, companies can make informed decisions about the economic viability of a merger. So we went through the real life example of Disney's acquisitions of Pixar. So examples like that would illustrate how these principles are applied in practice, demonstrating the importance of accurately estimating synergies and negotiating appropriate takeover premiums to ensure a successful merger that benefits both the parties. So then you have what are the risks and rewards in cash over stock offer. So I included this for your own reading. So since this is a reading for a degree, I would want to research further on the risks and rewards in cash over versus stock offer. I believe this should have been in here somewhere along these lines. Where is it? Yeah, somewhere along these lines, but never mind. Just have a research on the risks and rewards associated with cash offers and stock offers, so you would understand in certain mergers and acquisitions in real life how these advantages and benefits were incurred by the associated parties. But I would want you to focus is the final topic under the mergers and acquisition, which is corporate restructuring. So what it means, corporate restructuring. Corporate restructuring involves significant changes to a company's operations, structure, or ownership with the aim of improving the company's performance and value. So, one common form of restructuring is a divestiture, where a company becomes smaller by selling, liquidating, or spinning off a division or subsidiary. So, let's explore these sections one by one. First is the equity carve out. So this involves the creation of a new legal entity where new shares are issued. So a portion of the subsidiary's equity is sold to outside investors through an initial public offering or an IPO. So for example, I earlier also spoke about this when eBay carved out PayPal and later took it public. PayPal was issuing new shares, and a portion of these shares were sold to the public while eBay retained the remaining ownership. And then you have the spin-off. So in a spin-off, I'm sure you have heard this before in TV serials as well. So here, shareholders of the parent company receive proportional shares in the new company, and no cash is generated for the parent company from this transaction. So parent company shareholders receive proportional shares of the new company. So basically, the initial shareholders of the parent company are going to receive advantages from this new company. Basically, certain spin-off series have made their parent TV show more famous or more renowned. So this is some sort of a similar situation like that. So, for example, a spin-off of Agilent Technologies from HP, Hewlett Packard, HP shareholders received shares in Agilent proportionally, allowing Agilent to operate as an independent entity. So, after a spin-off, we have a split-off. So in a split-off, shareholders get shares in the new company in exchange for their shares in the parent company. So this often reduces the number of outstanding shares of the parent company. So in the split-off of Liberty Media from AT&T, shareholders exchanged their AT&T shares for shares in Liberty Media, which became a separate entity. And finally, we have liquidation. So this is the process of selling off a company's assets to repay creditors. So the remaining assets, if any, are distributed to shareholders. So one of the most famous examples of a Lehman Brothers collapse in 2008, the liquidation of Lehman Brothers during the financial crisis, where their assets were sold to repay its debts. And then we have the reason for divestiture. So we have identified different aspects of divestiture or the different types of divestiture, the equity carve-out, spin-off, split-off, and liquidation. Now we are going to focus on the reasons to have a divestiture in the first place. First is the change in strategic focus. So companies may divest parts of their business to focus on their core operations by shedding non-core assets. So here they can streamline operations and allocate resources more effectively. Just as when IBM sold its PC division to Lenovo to focus more on its services and software business. Then you have poor fit. Here, sometimes a division or subsidiary does not align well with the parent company's overall strategy or culture. So, divesting these parts can enhance the overall efficiency and focus of the company. So, for example, Procter& and Gamble sold its snack division, including the Pringles brand, to Kellogg's, as it didn't fit with the Procter& and Gamble's focus on health and beauty product. And then reverse synergy. Reverse synergy occurs when a part of the company is worth more independently than as part of the parent company. So by divesting this part, both entities can potentially unlock greater value. For example, when Fiat spun off from Ferrari, it was believed that Ferrari could achieve better growth and valuation independently rather than being with Fiat. And then financial or cash flow needs. So companies may need to divest assets to raise cash and either to reduce debt, finance new projects, or improve liquidity. So, for example, when General Electric sold its financial services arm, GE Capital, to raise cash and focus on its core industrial businesses. So, in an overall sense, corporate restructuring through divestitures would allow companies to refine their strategic focus, improve operational efficiency, and unlock value, as we have discussed so far. So, by understanding the various types of divestitures, the carve out, spin off, split off, and liquidation, companies can choose the most appropriate method based on their specific circumstances and objectives. We have also delved into real life examples as well. So, same as all the other scenarios that we were discussing, you can see how these are practically applied or practically demonstrated in actual real world scenarios as well. So, as stakeholders, understanding this concept would help to appreciate the complexities and benefits of corporate restructuring in enhancing overall corporate value. So that would be it under the mergers and acquisitions. So as you can see, a very few calculations were involved, very simple ones, and not really useful in order to be include them in a final exam paper. So what I want you to do is uh, particularly focus on these different areas under the mergers and acquisitions, and since the most interesting one being the pre-offer and post-offer defense mechanism. So particularly focus on that. It would be quite beneficial for you to focus on these to your upcoming exams as well. And when you go over not only pre-offer and post-offer defense mechanisms, but all the content, focus on the actual application of it, how practical firms, practical example, industries or companies actually implemented these methodologies in their circumstances and how they differentiate from each other. So you would really appreciate the complexities of the corporate world, corporate structure, and how they would overcome their stringent challenges with the careful consideration of the situation that they are currently in. So again, I want to highlight that I will not be giving you a calculation from this area. Rather than that, please focus on the theoretical aspects, the examples, and how they are going to impact on the overall concept of valuation as well. So this concludes the lecture series in your business valuation analysis class. So I wish you best of luck for your exams, and hopefully we'll meet in the future in another module, and let's continue our discussion in there. So thank you very much. Have a great day.